right. Thank you, Les. My name is Alex, and I'm a manager here in our Valuations and Advisory Department. So in preparing this presentation, I actually had quite a revelation. The reason being, I actually practiced this presentation in front of my one-year-old son. He fell asleep in 5 minutes. That had never happened before without me holding him. So I'm hoping that this won't have the same effect on you. With that said, as Jamie has alluded to, there has been new tax changes, which may lead to more valuations down the road. Because if those valuations aren't done properly, there might be adverse tax penalties and such. So with nothing further, let's just jump right in here. So what my presentation is on here is about the 7 most common pitfalls in valuing private companies. You can view these as kind of like 7 deadly sins, if you would like. So sins that you shall never commit when you do a valuation report or when you're valuing your private company. The first 2 has to do with more high-level kind of topics. The 3 will get into a little bit more valuation approaches and issues that we typically see. The last 2, lack of seeing the big picture. And of course, with any good presentation, I'll give you some actual suggestion, actual recommendation, and plan of action on how to address some of these pitfalls. First pitfall, not understanding the definition of fair market value. Not understanding the difference between that and price. When we're doing a tax valuation, what we're referring to is actually fair market value. And that comes with a very specific definition, as you can see up here. This definition is taken from the Chartered Institute of Business Valuators. And it's very similar to the tax definition required for fair market value. Price is a different concept. Price is actually something you would get when you list your business out for sale. And I put this as a common pitfall because one common question I get is, Alex, if you did a valuation for me and you came up with a number, 2 weeks down the road, someone comes down the road and offers me twice as much as your valuation. Does that mean it's wrong? The short answer to that question is no. The reason being, we had used the definition of fair market value in our report. What you're referring to is price. The buyer might have offered you more money because there's certain synergies they could have had, or they might have, overpaid for the business. The stupidity factor, if you will. So if you're doing a valuation, always be sure to first list out fair market value as your standard of value. Secondly, people typically forget the most basic principles of valuation. Value is a point in time, meaning what your business was worth 3 years ago is not the same as what it is worth today. And that's simple to get. Many people understand that. Value is prospective, meaning we don't care about what your business did in the past, but what we care about is what's going to happen in the future. And this is especially applicable to, let's say, high-tech companies. Many of them have negative earnings, losses. So you obviously don't look at that. What you're focused on here is what their future earning potential is. Third, the concept of personal goodwill. The best way to illustrate what I mean by personal goodwill is a value that can be transferred to a potential purchaser. So consider a barber shop. You go to a certain barber because you like him, you're loyal to him, you have a friendship with him. The moment he sells his practice over to someone, you're not going to go back. That's personal goodwill. When you have personal goodwill in a business, that lowers the value of your business. It's a little bit counterintuitive because you actually want to be as away from your business as possible to increase the value. Kind of think of Ray Kroc and McDonald's. He's made it into a turnkey system. No one goes to McDonald's because of the owner, but because you know what you're going to get because of the system. Now we're going to go into a little bit of the approaches. The most common approach that most CPAs do, I guess, when they value a business is to use the market approach. And many of us understand that because it's just similar with real estate. There's 3 typical approaches that's done, as you can see. The first 2, public company method and transaction method, is basically looking at comparables. But the 2 pitfalls of that is that rarely can you find a comparable company. Especially with transactions, there's very few private company transactions are actually disclosed. Many of them are quite outdated, and the sample size is quite small for you to draw any good kind of conclusion from. My favorite one is actually the rules of thumb approach. And that's typically, for example, manufacturing company. 30% of inventory plus 1 year of seller discretionary earnings. That's a rule of thumb. So I actually looked up how the origination of the rule of thumb wording came about. Apparently back in the day when ancient brewers brewed their beers, they would stick their thumb into the beer to test the temperature. I hope they don't do this nowadays because that just might ruin it for you beer drinkers out there. But it illustrates the point that the rule of thumb is a quick and dirty method. It's not reflective of the economic realities of your business. And CRA has typically viewed the rule of thumb approach as quite unfavorably as a primary valuation method. Secondly, we have another approach, or the asset-based approach, and most of us can understand this. This is your fair market value of assets less your fair market value of liabilities. The issue with this approach, of course, it doesn't consider any future value to your business. All it really is perhaps maybe just a base. And here is where a lot of atrocities happen, the income approach. This is where you get your 800-row Excel worksheets with if, and or embedded functions, and a lot of formulas. For those of you that might understand the income approach, this is where you project out your future cash flows, okay? Imagine an Excel spreadsheet. We're all accountants. We can see it in our heads. Top line cash flows. And then you have a discount rate. That discount rate discounts your cash flows into a present value. Make some certain adjustments to that number to come out with the fair value of your business. The issues with that is that there's always a bunch of unsupported assumptions. You think that the business is going to grow at 2%. Why? We need some sort of support there, and that's the biggest pitfall is the income approach, not having support for the assumptions. Two more items here's what's missing. I'm just going to touch briefly on the redundancies. What I mean by that is if your company had, let's say, marketable securities, that's not crucial to the functioning of your business, that should be added back to the value of your business, as you assume that a potential purchaser would sell those market securities on acquisition. Okay, so pitfall number 6, missing the story. So most of us are accountants and we like the numbers. So in the valuations world, there's typically two types of people, that the narrative people and the numbers people. And the two camps usually think that their side is superior, okay? People that are more grounded in numbers, whereas the other ones think that I'm more grounded in the story. Since we're a room full of accountants, most of us typically miss the story component of the valuation. And the story is actually just as important as the actual numbers. And I'll give you an illustration. Back a couple months ago, I spoke with a CBV, and we were just chatting, and he told me about a recent valuation that he did years ago. And that was for a paper company, okay? Ever since Gutenberg invented the printing press, paper's done well, right? You had books printed, Bibles were distributed, etc., so it grew. But here's an interesting thing. In about the 2000s, something happened. Apple came about and came out with the first iPhone. You had something that you could do a touchscreen, right? And there, his team decided that, look, we don't think paper is going to do that well from this point onward. The reason being, it's going to be replaced by mainly touchscreen devices. And so in their valuation, they projected negative growth. Just think about that. Just telling a story like that can help you understand what the biggest assumption in that whole valuation was. That business in the paper is perhaps not going to do as well in the future. So I want to stress, you want to add flesh to the bones. You want to add a story to your valuation. After your valuation is complete, one common thing that we see missed is just a basic step back and do a common sniff test. Does this valuation make sense? Ask yourself, would I purchase this? Would I pay for this amount for the business? Even asking something like this will really help avoid issues down the road. So now we get to our best practices and recommendations as to what to do when it comes to completing a valuation. And that's to consider all three approaches. So I talked about the asset approach, that sets your base value for your business. Consider the income approach, that'll capture your future value. And then test your value derived under the income approach with the market approach. Compare it to other companies. And what I mean and how you do that is basically work out some ratios. What does your valuation imply as a percentage of revenue, as a percentage of, let's say, income? Compare that to, let's say, public companies. You should see that your multiples will be lower because yours is a private company. Keep in mind, public companies typically demand a higher multiple. So this is something that would be very good for you to consider all three approaches when you complete a valuation. Integrate all three. And of course, provide a story and a narrative. You don't need to write a whole book about it, but at least put in point form, these are the basis of my assumptions. I projected my company to grow at 2.5%, which is tied into the GDP growth rate of Canada. Tell a story. make it interesting, right? You can list it as bullet point form or write it in a short memo, and that just really makes your valuation a lot more stronger.